Jimosophy, interpreting events to build wealth. Hear that sound? That's real estate falling. Today is November 27th, Friday, November 27th, 2020. It's Black Friday. It's the beginning today of the end for real estate. Going to lay it out really simple for you. This is why it starts now. Number one. By the way, it's going to start in Canada, Australia, New Zealand, the United Kingdom, and even in the United States of America. Deferrals come due. Mortgages must be paid. In Canada, there's 500,000 mortgages that came due on October 31st. The deferrals were huge. They were in the millions. Now, it's pay-up time. They've been deferred for 6 months, and it's time to pay it back. So I hope you've got the money. It's the most overvalued market in the world. In Canada, real estate sells for about 10 times household income. I mean, imagine borrowing, paying $1 million for a house. You know, if you save $40 a week every year for 500 years, you could pay back the $1 million. The price of the real estate to the household income is about a factor of 10. Usually, historically, it's 3. So we have a market incredibly overvalued, 350% higher than the norm. So number 3 is unemployment. We have double-digit unemployment numbers. The pandemic has caused unemployment to rise, and it's actually going to translate into structural unemployment because employees that the employer knows they don't need won't be recalled. And they can see now after what employees they do need, and they're going to make the adjustment. So probably 1 out of 4 or 1 out of 3 that were let go during the pandemic won't be recalled because the business knows they can do without them. So unemployment's high. I don't know how you're going to pay your mortgage or how you're going to make your payments on your student loan, on your open line of credit, on your home equity line of credit, on your car loan, on your mortgage with no job. Incomes. Incomes are not rising. I mean, it would be fine if housing went up 10% and wages went up 10%, but real wages are not rising. And you need income to pay these higher and higher amounts, and it's just not there. We also have very low immigration. So the countries that I mentioned, the COVID has stopped or very slowed down the immigration levels to increase the demand. And who wants to travel to a place that has a high COVID rate? So that suppresses demand. Indebtedness. Canadians are the most indebted in the world. Over 100% of GDP is owed in debt. And there comes a point where you've just taken off too much. Number 7, it's a speculator-driven market. 40% of the condominiums are speculator-owned, and they're the first ones to enter the market because, keep in mind, they're only there to make a quick profit. They don't live in them. Number 8 is inflation. Inflation is very low, but it excludes assets. The stock market, the Dow hit 30,000 a couple of days ago. Real estate hit new highs last month. And we're seeing very low inflation. If they actually included assets like the stock market and real estate in the inflation reports, then we probably see inflation not at 1%, but at 10%. And of course, that would make interest rates substantially higher. So it's an underreported level. It's not realistic. Number 9 is supply is increasing. So, it takes a couple of years for an apartment building, a condominium, a house to go through its permits to be built and to come onto the market. And we're seeing from 2 years, 1 year, 6 months, those supplies are just going to come into a market where there's no demand. And number 10 is COVID. The governments of the world shut the economy down when we had 50, 100 cases of COVID in March this year. Now that we're in the thousands and thousands of cases, depending on where you're living, per day, they realize they can't do that. And of course, that move, shutting it down, listening to the health professionals instead of the economists, will prove a big flaw. And number 10 we talked about is COVID. Number 11, this is the one that's the real wild card, interest rates. Interest rates are at an absolute historic low. They're very close to 0%. Now, they can't go below zero. I know you hear about negative interest rates. That only happens in the bond market. Somebody's going after a high interest rate bond with fixed payments. But the banks are not going to lend you money below zero. They have a deposit rate, and they can only lend at a higher rate than they give their depositors. So we've hit the all-time low in interest rates. If I drew a graph, you'd see from 1981 to today, interest rates have come from 20% down towards zero. Now, you would be very, very naive to think that the history of interest rates, which average around 8% over the past 100, 200 years, are going to bottom at zero and the graph will just stay flatlining at zero. It can't go below zero, so it can only go up. And a lot of people have borrowed at 2-3% mortgages. With historic rates at 8%, 2% on $1 million mortgage is $20,000 a year. But when it goes to 4%, which is still really low, you have to pay $40,000 interest. If it goes to 6%, $60,000 interest. 8%, where it usually is, $80,000 a year interest. So your payments go from $20,000 to $80,000. We don't even want to do the math at 21%. That would be $210,000 a year on a mortgage, which would cause you to default. So interest rates have nowhere to go but up. And that is really, really the key driver for your credit, is the low interest rates. So we have no reason in the world for real estate to rise. And we have the deferrals coming online. We're entering the winter, which is traditionally a very poor market for real estate sales. Lots of supply coming online. A huge run-up in prices. Heavily indebted people, falling incomes, low immigration, high indebtedness, speculator-driven, inflation grossly understated, supply increasing, and rising COVID levels. It's the end. Over. But you say, there's a cure for COVID. And there is. They'll vaccinate, and late next year, there will be a tremendous explosion of spending. Not by people that are in debt, but by people that aren't in debt. They've just been waiting to get on the airplane, to cruise, to get away, to spend. And they will spend. But they already own houses, the people with money. And they don't want more. What will happen is inflation will actually rise next year, late next year, because it does exclude the assets, but it does include all the goods and services that we typically buy, and they will explode in price. Inflation will rise, and interest rates have to rise to temper inflation, by definition at all central banks. The irony is the vaccine will accelerate the crash in real estate. It will explode consumer spending on typical items and vacations and luxury items, but it will kill real estate. That's the irony of the situation. Next year, you're going to see it accelerate down. And another thing, you're going to say, well, if it's falling, I'll just buy when it's cheaper. You won't. No one buys into a falling market. That's why it's falling. People buy into a rising market. That's why it's rising. Unless you're Warren Buffett, and I doubt you are, you won't be able to take advantage of that. And by the way, somebody has to lend you the money. With values of real estate falling, your collateral for the mortgage is falling. Appraisers will have lower values. They won't give loans. People will become afraid. Greed can last for dozens and dozens of years, but fear is quick. It quickly turns to a panic. If somebody yells fire, we run. And when these prices fall for real estate, they're going to fall quick. And so is the collateral behind them, and the crash will ensue. So remember, Black Friday 2020, November 27th, the call, it's over for real estate. Thanks for listening. And be sure to visit Jimosophy.com to read more about it. Jimosophy, interpreting events to build wealth.